In our time together today, I'm going to cover off quickly what GVF is about. And then it's our 10th birthday. So I've put together a little timeline, a bit of a trip down memory lane, if you will. And then after that, Miles will run through what's going on in the world, the macro from his point of view with the guys in London. And then hopefully we can go through a few case studies, if that's good with everybody. Okay, so let's get cracking. So Miles, as a reminder, is the CIO, and I am the CEO of a company in London called Staude Capital. Staude Capital is seconded into the ASX-listed Global Value Fund. We've been ASX-listed for 10 years this July. And we're a team that has a very strong independent board. You guys will recognize all those names from the IPO. And as a reminder, GVF is a boutique investment strategy. We have a unique strategy. We're not stock pickers. Instead, we go around the world looking for a very specific type of investment. Now, that specific type of investment around the world usually they usually have three things in common. They tend to be listed, they tend to be closed pools of capital, and they tend to be closed pools of capital that can hold pretty much any asset class. So we can buy global shares, we can buy global bonds, we can buy anything across the asset spectrum. If it has a value, it has interest to us. Now, if you or I want to invest into those investments, we do so by buying shares on an exchange. Ideally, the value of those shares should match the value of the assets of the underlying portfolio, but it's in cases where they don't match and where the shares are actually worth less that our ears will prick up as something that's interesting for our investment strategy. When we do find an investment that works, we like to explain to our investors that we eventuate to two sources of returns for them. First, there's the returns that come from the underlying assets that we've purchased. And then secondly, there's the returns that come from the fact that we purchased those assets at a discount and we've then sweated that discount out. And we've done a pretty good job of that, to be honest. And that pretty good job, we've annualized at 11% per annum after all fees and expenses, has been used to pay investors a high income over time. And it's been a very consistent income. We paid the first dividend within the first year of listing, and we've paid one every 6 months thereafter. As well as paying that high consistent income, we've also put a huge emphasis on capital protection, protecting investor capital. Now, I appreciate that a lot of investors will potentially talk about protecting capital, but rather than talk about it, I think I might just show you a picture. And I may well have shown this to you in the past, but it's just worth reminding. This graph hopefully demonstrates our ability to protect investor capital. It shows it shows every single investment that we've ever made in the 10-year period that we've been going. And it shows the profits there on the left-hand side of those trades and the losses on the right-hand side. And hopefully when you look at this graph, you can see two skews. First, there's a lot more wins than losses, which is hopefully a good thing. And then secondly, the quantum of the wins versus the losses is really, when we make money for investors, we make money. And when we lose money, which is inevitable with all investing, we have this real ability to protect on the downside. To say this graph in another way, in the 10 years that we've been going, we actually haven't had a down year. So we haven't had a negative year of performance. We came very close in FY 2020, but still managed to eke out a tiny positive return, which in the end matters. I mean, that's a little bit about GVF. I know a lot of you guys know us already, but I just thought it was worth a quick little summary. And then because it's our 10th birthday, which is quite a big milestone, if you think about it, we thought we would just go on a bit of a timeline, remind ourselves of what's gone on in the decade that we've been in existence. So let's rewind back to 2013. And this guy, This guy has been trading this strategy for a while at that point. And has had a few high-profile cases in the Australasia area, but it's around this time in June 2013 that Miles and I meet Jeff Wilson for lunch. And at the time, Jeff was actually, if you know Jeff Wilson, at the time his WAM capital was probably a fifth of the size that it is today, and he probably only had 3 funds. So he was much smaller. He was keen to see the space grow, and he said, "Hey, I'll introduce you to some good board members," and he did. He introduced us to Chris Cuff and Jonathan Trollope, and I'll take you around. You can meet my investors, and we'll see what they think. And I vividly remember Miles coming home to me one time and saying, there's no guarantees at all, right? Like, nobody knows me. I don't know how many people actually understand this strategy. This could really blow up in our face. And I remember thinking, it was just before we were about to get married, because we've just had our 10th anniversary. I remember thinking, wow, this guy's a real catch. But we carried on. And it actually worked out really well. On the 17th of July, 2014, we raised $54 million, more than was expected, from 1,600 amazing shareholders, a lot of whom are still with us today. And the strategy started off strong. What I'm going to show here on the graph is I'm going to show our performance over the 10-year decade, but I'm just going to tell you what events have happened at certain times. Now, you will know what those events did to financial markets. Most of the events were shocks to the financial system, but in the background, I will show you what GVF has done. So we got off to a strong start and paid the first dividend in that year, in the November following, and we'd pay a dividend there every 6 months after that point. And it wasn't an easy time. I mean, June 15 to June 16 was a very tricky time. China in particular was down 43% over that period. And it was around this time in June, kind of early 2016, that I came on board as the CEO. And it's kind of just as well, because we started to get some real shocks. We had Brexit, which really wobbled financial markets, in particular the London Stock Exchange. Then we had the surprise at the time election of Donald Trump, which again was quite a shock. And because there wasn't enough going on, Miles and I decided to have our first child. By the December 2018, markets had to deal with the worst December since 1931. But again, we continued to kind of trundle on and keep going. And it was around this time that we decided that it would make sense for us to employ a co-portfolio manager in London. And it was a real boon for our business. We ended up hiring a chap called Mark Ambrose, who we'd known for a very long time and had a huge amount of experience in our particular strategy. And he joined us just in time for COVID, which obviously was something that was a big shock even to our performance. That year, however, we did manage to rebound quite quickly and still, as I said, produced a positive return. It was followed by our best year in 2021. 2022 sees the Israel-Hamas war. Russia invade Ukraine, and that remains a very difficult thing for markets to digest. FY 2022 was a very, very tough year for asset classes across the board. Everything pretty much lost money, but again, GVF was managed to produce a almost 3% return. Around that time, Miles and I would leave the headquarters of the UK to our team of 5 over there, and we've set up an office in Australia to focus on the Asian and Australian markets and to spend a bit more time with our shareholders. And then we had the breakout of the Israel-Hamas war, which again has wobbled financial markets and continues to be something that is troublesome. So I hope that by going through these 10 years, I hope what I can illustrate to you is, despite the volatility of the markets, despite how much has gone on, despite how many distractions Miles and I might have had at home, we've still managed to kind of produce those consistent returns. However you've chosen to use GVF, whether you've invested at the IPO and reinvested everything, your $10,000 would be worth just over $24,000 today. If you invested $10,000 and you've taken the income, you would have received $8,000 in income, and your $10,000 is worth just over $11,500. However you've chosen to use GVF, I hope that you'll agree that these first 10 years have been something that we can all be very proud of. And I hope that you won't find it too presumptuous when we wheel out the birthday cake a little bit later. On that note, I might hand over to Miles to let us know what is happening on the macro level.
I'll do my best.
For sure.
I have a tendency to speak a bit softly, so if you can't hear me at the back, please don't struggle on, just let me know. And one thing I'm loving to point out, just to help my case at home domestically, every time we've had a child, just look at the tremendous run of performance the fund has had. I think that's
No, shop is closed. Sorry.
So look, we don't express big macro views in the Global Value Fund portfolio. We've got a philosophy that we stick to regardless of what's going on in the world. But we are in the markets every day, and we can't ignore what's going on in the markets every day. And we do obviously position the portfolio, particularly when we're thinking about managing risk, to take account of the big picture. And I just thought I'd share a few points on the big picture for intrastake, and also I think to help people think about where you put capital today, how you might want to think about framing that. And to do that, sort of zooming out, I think the really important thing to understand today is that there's been two big developments that have driven most of the price action in global financial markets for the last 18 months or so. To sort of frame the picture, we need to rewind back to this time last year, the start of 2023. And if you recall, at that time, the world was a pretty bleak place, especially in financial markets. Coming out of COVID, inflation had come back with a vengeance, and to deal with that, central banks were aggressively hiking interest rates all around the world. Interest rates were going up at their fastest pace in over 40 years, fastest pace in a generation. In the US, probably the most important economy, the US Fed would hike interest rates by over 5%. Here in Australia, the RBA hiked by over 4%, and there were similar hikes of similar magnitudes all around the world. And, you know, given interest rates had been so low for so long, shifts of that magnitude really represented a big shock to the economic system. So the consensus, the economic sort of forecast was a shock of that size, having had interest rates so low for so long, would lead to a nasty recession. At the same time, and I personally think this is a little unfair, but at the same time, the narrative in financial markets was that central banks had been a little bit asleep at the wheel. They'd let inflation get out of control coming out of COVID. They hadn't been paying close enough attention, and there was an enormous amount of political and social pressure on central banks to get the cost of living crisis under control. And you see that in the papers every day today still. So you had a situation where interest rates are going up very quickly. Central banks are more worried about containing inflation than they are about economic growth. And you can see the backdrop for why everyone was worried we would be going through, about this time, about now, 2024, a really nasty recession. Against that kind of bleak outlook, the real surprise has been this. Global share markets, as a proxy for kind of most higher risk assets, have had a tremendous run. From the start of last year to the end of April this year, global share markets, as measured by the MSCI index, are up nearly 30%. Now, over the long run, we should probably expect an asset class like shares to generate 7, 8, 9% a year, every year, annualised. So to move that far that quickly is quite a move, and particularly against the backdrop where we all thought, gosh, a nasty recession is coming, that's really quite a development. So what happened? Well, these two big themes that have gone on, and really two big shocks to financial markets. The first one's been artificial intelligence, AI, something that I'm sure you've all seen in the papers and people talking about a lot. And essentially, with the release of ChatGPT at the end of 2022, investors started to appreciate that the companies that go on to win the AI arms race, that get the market share in the dominant position, are poised to make enormous profits, a bit like the tech stocks of old and during the dot-com boom. And that kind of excitement for AI and AI stocks has pushed a small handful of technology companies, your Apples, your Amazon names that you all know, dramatically higher. The navy line there represents what's come to be known as the Magnificent Seven. 7 ultra-large tech stocks in the US that investors are betting are the ones that are going to win the AI race. Now, just to sort of help shape the framework here, the dotted line at the bottom, the MSCI All Country Index, it's the most widely followed global share market index in the world. It has 1,400 companies in the index. The navy line at the top is 7 companies. It's less than half of 1% of that index, but they have been so strong, their performance has nearly doubled in the space of a year, that they've literally dragged the entire index higher. If you look at the bottom line now, that is the rest of the global share market, the other 1,393 companies out there. And you can see until about October of last year, they've really gone nowhere. If you haven't owned the artificial intelligence stocks throughout last year, especially for the first half and really towards this, till October, November of last year, global share markets had basically generated no return. And that's what you'd expect in an environment where we're worried about interest rates, inflation, and a looming recession. A higher risk asset class like share markets would naturally struggle. And this navy line at the bottom, unlike the AI stocks at the top, is much more exposed to the traditional economic cycle than the technology stocks. So they're much more exposed to that risk that I was talking about at the beginning, that a sharp rise in interest rates would really damage or dampen the economy. You do the pointing. Okay, forgot we're recording. That brings me on to the second shock, the other big kind of development in financial markets recently, and that's really been the US economy and how it's kind of astounded everyone at how strong it's continued to be. I'm going to show that here with 2 charts, hopefully. So this is data looking at the US economy, still by far the biggest and most important economy in the globe. The first chart here just shows interest rates in the US. And you can see, start of 2022, interest rates, like here and like most of the developed world, were basically zero. Money was basically free. Over the space of 22 and 23, you can see interest rates were progressively hiked very quickly, one of the fastest hiking cycles we've ever seen, to over 5.5% by sort of late 2023. Now this second chart here, I'll explain it. It takes a little bit of thought, but it's essentially what the market is expecting economic growth to be in the United States in 2024. So you've got teams of economists out there, teams of market forecasters, they're crunching all the numbers, they're coming up with their best guess of what economic growth is going to be like in 2024. And it measures that consensus estimate as we move through time. So you can see at the start of 2022, the navy line starts at, and the scale for this is on the right-hand side. The start of 2022, the consensus estimate for US economic growth in 2024 was about 2%, which is about trend growth or about average growth for a large developed economy like the United States. And you can see, hopefully, if you look at the first half of the chart, as interest rates kept getting pushed up, the market's expectation for US growth in 2024 kept getting pushed lower and lower and lower, and it reached its zenith at exactly the same time that the Fed undertook its last hike in sort of the third quarter of last year. And that's kind of classic textbook economics. If you go back and look at the data and look at every developed market economy in the world since the Second World War, so a huge data set, and you look at what happened when interest rates were lifted by more than 4%, so a dramatic change, when inflation was already high, pretty much every economy goes into a nasty recession. So there were good reasons for economists to be worried for what was coming up. And you can certainly see that's what the market was pricing in. If you now look at the second half of the chart, from sort of October onwards, the real surprise has been the economic textbook has basically been thrown out the window. It has confounded all economists, all market participants. We're 2 years into probably the most aggressive hiking cycle in history in the US, and it's hard to see any real slowdown in the economy at all. It's absolutely amazing. The unemployment rate has been below 4% for over 2 consecutive years now. That hasn't happened in over 50 years. The labour market remains enormously strong. It keeps sucking workers in with high wages, strong demand. And that's kept house prices high, consumer spending strong. However you look at it, whatever kind of data point you want to get, economists have been resoundingly wrong for most of the last year. The economy in the US has just held up in a way that nobody expected. And you can see that now in the second part of the chart. Expectations for this year, 2024, have shot enormously higher. And, you know, in a financial market context, that's really rare to see that kind of change in expectations in such a short period of time. It's kind of like driving down the freeway at 100 miles an hour and trying to do a handbrake UE. It's really rare to see. Basically, 6 months ago, the market was expecting a recession in the US, a couple of quarters of negative growth, a couple of quarters of positive growth gets you to a barely positive number, to now we're expecting the US economy to grow above trend, faster than its natural capacity. Really quite remarkable. Now, if you keep that image in your mind and you shoot back to the last chart, you can see that big change in expectations in the US corresponds with a big lift in markets for the non-AI parts of the markets in the second part of the year. So how come share markets have been so strong over the last little while? They've been dragged higher by artificial intelligence excitement, and then also a remarkable US economy that's really dragged the rest of the world along with it. Now that's all really exciting. Why does that matter? And what does it mean going forward from here? Well, it matters in our view at least, because I think people need to appreciate that there's two very different engines that have been driving markets and will probably continue to drive markets for the foreseeable future. The first one is the AI revolution, and it's a tremendously exciting technology. It's a very high risk, high reward kind of investment space. But the success of those companies has been so big, so great, it has literally changed the makeup of global share markets. You now have a situation where those 7 companies, the Magnificent Seven, have a combined value of $12 trillion. That's bigger than the combined economies of Japan, Germany, and the United Kingdom. They're absolutely enormous companies. And in becoming so big, they dominate the index in a way we haven't seen before. Today, those 7 companies make up 20% of the global share market index. So if you have an investment in an ETF or an investment fund that tracks that benchmark, and there's a lot of money that does, a very large part of your wealth today is tied up in what are high-risk, high-reward companies. And to call a spade, you know, a group of companies that can double in value in a year can certainly halve in value in a year. Now that might be perfectly fine for your circumstances in life, but I think it's very important to go into that with eyes wide open at the moment. If you're at a later part of your investing life, you can't afford a big capital drawdown, having a large amount of your wealth tied up in names like that is certainly something to pause and consider. The second thing, and I think this is something that's gotten us a bit exciting, is there's been a radical change. So that's driver number one. You need to decide if AI is appropriate for you. I think the other drive has been this dramatic renaissance in expectations for the US economy and a dramatic kind of improvement in the basic economic fundamentals. It wasn't that long ago we were expecting a very nasty debt default cycle. We invest into the debt markets. It's a very big backbone for a lot of investors that generate yield. Debt default cycle coming because we're going into a nasty recession, or in the stock market, growth is going to slow enormously, company earnings are going to take a big hit. Everyone was geared up for that. I think the thing that we're very optimistic about is that in the more kind of traditional / boring parts of the old economy, the outlook is actually quite optimistic at the moment. We're certainly much more positive in terms of investing in the parts of the market we like to than we have been for some time. So I think that's kind of how we're seeing the big picture. Two important drivers. One where we focus normally is in traditional economic stocks and bonds. The outlook's looking a lot better than it has for some time.
Before you do the case studies,
Yeah.
I'm just wondering whether we
I
just
think
do a
that,
quick summary.
and you might want to stand in front of the mic while you do that.
Sure. Miles and I are doing a debate next week, active versus passive, and I feel as though he was bringing some of his arguments to the table there with his speech. Exactly, trying them out. I just wanted, before Miles does the case studies, I just want to do a quick reminder of how the portfolio is constructed, because when we come out, we do these great case studies, but we often choose ones that are pretty exciting, and then I think people go away thinking that we specialize in like music royalties or something. We really don't, and the majority of the portfolio is still very boring. But what we do, just as a reminder, we go around the world looking for those very specific types of investments, and we ensure that we have a very diversified basket of underlying assets. So we don't just go and buy global shares because we feel excited about that. We always make sure that our underlying portfolio is extremely diversified. And you can see there's always a big equities or shares exposure, there's always a bond exposure, and then there's things like private equity, hedge funds, real estate, music royalties. And then obviously by investing around the world into all these different assets, we then end up holding a basket of currencies. And again, we're not trying to be clever with the currencies. We don't believe we can add any value there. So we just hold a kind of diversified basket of currencies that reflects the global investable universe. The exception being the Aussie there. If we pick up any currencies that are a little bit exotic, we hedge them back into Australian dollars because obviously the company is in Australian dollars. And just as a reminder how that looks, these first two waves are the assets and the currencies. So you can see there that those are the assets, those are the currencies. If you put those graphs together, you can see it's pretty benign, probably about 6%, 6 or 7% per annum that those have produced, and that's what we would expect from a low-risk portfolio. The way that we've achieved the higher returns, and it's actually 11% as of April, we strap on top the discounts that we find around the world. So I just want to put the case studies into perspective before we go, and I'll point for you if you like.
Okay. Thanks, Emma. That's a good way to summarize it. We buy boring investments, but I'd caveat that and say we buy boring investments at tremendously exciting prices, and that makes them very exciting. I've got two case studies here, and really I wanted to go through the first one just to sort of touch on a bit of Emma's point. I mean, some of the most exciting things that we find really are opportunities that the market has missed. They're not very glamorous. They're not sort of high-profile activism. They're nothing too clever. It's literally turning over lots of stones and finding very, very cheap companies that are still of very good quality. We're just buying them at incredibly cheap prices with a clear path to get that cheapness out. And I think this example here, Starwood European Real Estate Finance, is a tremendous example of that. We've actually owned Starwood or SWEF twice in GVF's life, and both times they've been very large investments in the fund, and both times, touch wood, they've been very successful. Just to explain what it is, so Starwood is an investment company, a bit like GVF itself. It's listed on the London Stock Exchange, and what it owns is a portfolio of European real estate debt. So it doesn't own stocks, it owns the debt, and it's run by one of the largest real estate specialty groups in the world, a group called Starwood. They run they run $100 billion. So I think they're probably the largest or one of the largest real estate investors in the world. They've got an incredibly strong team, and they go and find these really interesting loans that they can underwrite to property companies, people doing refurbishments, or companies that just need some debt, and they underwrite them in a way that banks can't. They're very specialist loans, and because they've found this niche, they earn a very interesting interest rate, a much higher interest rate than perhaps you might normally expect, on loans that are generally very well covered. And you can see it's actually it was a very successful model. You can see on the bottom right chart there, in the navy, the share price of SWEF on the London Stock Exchange, and in the grey, the value of that loan portfolio through time. And you can see for a very long time, the share price actually traded at a premium to the loan portfolio, which is a function of a high caliber manager, a really interesting loan book that paid a high and consistent yield, and a great underwriting process that saw no defaults over a 10-year period. That obviously changed during COVID, and COVID really took a hammer to the real estate industry in general. Even today, there's lots of office blocks sitting empty, lots of high street shops that are sitting closed, which is very sad. And obviously coming into COVID, thematically, there was lots of reasons to be worried about anything to do with real estate. The problem with those kind of big picture views, though, is that it lends itself to kind of missing what's nuanced and important and the detail about every situation, and that's what happened during COVID. You can see the Navy, the share price sold off enormously just through generic real estate fear. That's when we turned up. The team and I did months of due diligence on the loan portfolio, got to know it really, really well, got very comfortable that the loans were actually okay, despite all the scary headlines. And we're really impressed with what Starwood did at a sort of a loan-by-loan basis to protect their portfolio. A great example, I think the largest loan, or one of the largest loans in their book, was a loan to a hotel in Dublin. And obviously, hotels were decimated during COVID. No one's travelling, no one's booking rooms. And the main thing with a hotel is you've just got to keep occupancy up. That keep the lights on, pays the interest bills, keep staff employed. What they did, which I think was a tremendously clever idea, they sat down with the Irish government and said, look, you've got pandemic workers working all kind of crazy shift hours all over the country. They need somewhere to sleep every night. We have a hotel that's sitting empty, and they struck a bespoke deal with the Irish government, which meant that pandemic workers could use that hotel all throughout the pandemic. They didn't get the highest nightly room rate, but they had 100% occupancy. And even the best hotels in the best of conditions never get 100% occupancy. So it guaranteed this fantastic cash flow stream all throughout the process. Meant interest payments were paid all the way through, none of the loans defaulted, and staff were obviously kept on. So on a case-by-case basis, they'd gone through the portfolio and come up with clever solutions like that. GVF, in all the kind of fear that was going on, GVF had managed to buy the book, the loan portfolio, at 80 cents in the dollar, huge discount. And a couple of years later, when there were no defaults on the portfolio and we'd received a lot of coupon income, the share price re-rated enormously, and it was a very successful investment for us, and we exited at that time. It's come interesting again, and sorry, this was really the point I wanted to make. Today, it's a very different proposition. We're not in COVID, there's no kind of big picture concern about the loan portfolio. The loans continue to perform very well. I still don't think there's been any defaults at all. But the company has gone into runoff, to liquidation. There's no nefarious reasons. This is a tiny little company. Starwood manage $100 billion. So they've just decided they don't want to run this vehicle anymore. And essentially, as the loans mature naturally, the capitals were paid to shareholders, and at the end of that process, the company will be put into liquidation. What we love about situations like this, what we go and look for all around the world, is often in these kind of small, illiquid names where people have kind of stopped paying attention to them, the price can get really, really cheap. And I think that's a function of the managers not out there marketing anymore. No one's really that excited about the company. And the share price drifted, and we're essentially able to build a very large position for GVF, for our investors. Again. I think it has been the second largest investment in the fund for most of the last year. At this time, at about a 15% discount. So we're buying that loan portfolio at 85 cents in the dollar. And we obviously know the loan portfolio very well from our first investment during COVID. And one of the things that we really liked about it was it has a floating rate loan book. So what that means is as interest rates go up, the interest rate you receive as an investor goes up with it. Interest rates across the UK and Europe have gone up enormously since we owned it during COVID. And we've also bought that loan book at a big discount. So combined, I think the running yield that we're receiving as a GVF investor is over 10% today. So we're getting a huge coupon just to sit there. On top of that, we've bought the loan book really cheap at 85 cents in the dollar. So every time the loans mature, we get the money back and we take a big uplift. We've bought $1 for 85 cents, we get $1 back. In the year that we've owned it, we've had 30% of the loan capital back. We've taken a big uplift in the fund each time. And if we add on top the dividends we've received, I think we've had over 50 cents in the dollar since we started buying this. And we believe there's a hell of a lot more than 50 cents in the dollar still to come. What we really like about investments like this is, like in our assessment, we think we'll probably make a 40% return over the life of the investment. We'll make that return over 3 or 4 years. So it'll annualise at sort of a mid-teens kind of number. Tremendously exciting return figure. But I think the thing that we're as excited about is the risk profile. The underlying risk here is not FANG stocks or high-risk technology stocks. It's a loan portfolio with a loan-to-equity value, a loan-to-debt value of 60% across the entire book, where there still haven't been any real defaults across the portfolio, and now a vehicle that's been run for 20 years. And it's a much lower risk proposition than, say, investing into the share market. Obviously, it's not risk-free, but for the return that we're getting, if you remember Emma's skew chart before, we think these kind of propositions are fantastically exciting kind of risk-adjusted returns for investors.
Yeah, especially in the context of the fact that that loan book has gone through COVID and has...
As a test of a cycle, yeah, exactly.
And against the economic backdrop that you've just described. I see that. Okay.
And then lastly, this is the rock and roll, pardon the pun. We've talked about this investment a lot recently. I won't dwell on it too much, but if you heard us speak last year or you heard the presentations that were going out, we talked about how we'd made recently a big investment into the music royalty sector, which is a bit of an unusual asset class. Just to run through what it is, so music royalties is literally buying the catalogue, the pop song catalogue of Beyonce or Justin Bieber, and you own that catalogue, and every time the songs are played on the radio, or these days, more importantly, on Spotify or digital consumption, you earn a royalty. And 4 or 5 years ago, when interest rates were really, really low, it was a really attractive asset class. The value of these music royalty portfolios was going up in time. At the same time, you're earning a really attractive coupon, 7, 8, 9% to sit there and own the catalogues. And you can see the sort of the backdrop in the music industry as it's going on. So this bottom right chart shows where people have made money in the music industry over the last 50 years. You can see with the lovely Emma's help. So the first wave is vinyl. Then you have cassette tapes. Then the big peak and crash is CDs, and the market, was incredibly exciting for a while. And then everyone realised or learned how to pirate CDs, and that all the money disappeared. More recently, what's gotten everyone excited is digital consumption. So all the kids today on TikTok, on Instagram, Apple Play, Spotify, there's been an enormous growth in music consumption as a good, growing at sort of 15% a year every year for the last 5 to 10 years. So a lot of money, a lot of private equity money's come into the space. It's got a very kind of favourable tailwind, and people are quite excited about it as an asset class. During that kind of hubristic phase, a couple of companies listed in London, and their sole purpose in life was to go and buy music catalogues, hold on to them, earn the income, and hopefully as well see the value of those catalogues go up through time. And it was a very exciting time. They raised a lot of money. The two companies were Hypnosis Song and Roundhill. About 3 years ago, however, the music stopped, pardon the pun, and interest rates went up a lot. And investors who had been able to earn a 7 or 8% dividend from investing in these companies could suddenly get a 7 or 8% coupon from putting the money in a Tesco's bond or lots of other places. So a lot of the excitement came out of these names, and we could buy them. We turned up buying both of them at big discounts to book value, 40% discount. So we're buying the portfolios at roughly 60 cents in the dollar. Now, it was a rather esoteric asset class. The team and I did a huge amount of due diligence on the asset class and the companies as well before we made an investment. And you can see our buying periods in the grey. And I think last time we were out here, we were just talking about Roundhill. So the Hypnosis Song hadn't happened. Roundhill was a relatively small company. We'd bought a reasonable size, but not a very meaningful size. And not long after that, there was a takeover bid at an enormously higher price. I think plus 50% to our entry price in a very short period of time. It was obviously very exciting, but it was, I guess the frustrating thing was because Roundhill was a small company and we hadn't been able to get a lot of stock in it, it wasn't very meaningful for the GVF portfolio. But the thing that really helped was that it really, I think, for the team and I, validated all the work we'd done. It's one thing to sit in a corner, to days and days of work in an Excel workbook and come up with a number that you think is the right value for these portfolio. It's another thing to see someone come in and say, actually, I'm going to pay you a cash price for that portfolio 50% higher. That gave us a lot more confidence in Song. Now, Song, the Hypnosis Song, the grey line, is it? Yeah. Has been a much messier story. I won't drag you through it all, but
so this is where we were visiting October last year, and that's what's happened since.
This very messy story. So basically, it's a much bigger portfolio. We're able to build a much bigger investment for GVF. This really became quite a meaningful position in our fund. And the optics and the backstory looked bad for a very long period of time. Essentially, the manager, in our view, hadn't looked after shareholders in the right way and had done a few kind of dubious things along their way. They'd signed they'd done a partnership with Blackstone, the big US private equity group, and there was a backstory here where Blackstone were essentially trying to get their hands on the catalogue or the best parts of the catalogue at a tremendously, in our view, a tremendously unfair price. They were trying to diddle shareholders, in our view. The optics in the press were terrible. The share price kept going lower and lower and lower. We kept buying and buying and buying. We're very confident in the underlying value. And one of the things that we can do well is constructivism or activism. And we were very active in the background here. And us, along with a group of other shareholders, during that time, changed the composition of the board. The chairman left, and we actually brought in the chairman of Roundhill, the company that had sold itself for a big premium. There was also a lot of other negotiations with the management and a lot of kind of positioning behind the scenes, a lot of hard work that we did. It was, however, a real test of our conviction for a while. You can obviously see how it's ended, but before that, there was a lot of stock coming at us at progressively cheaper prices. We kept our nerves. We kept buying the stock at what we thought was a very exciting level. And we thought it would be something that would play out over a few years, that we'd sort of slowly liquidate the company, sell the catalogues back to the market at a fair price and realise our investment over maybe a 2 or 3 year window. However, it's tremendously exciting and pleasing to say that a bidding war has started. It started last month in April. We've had four takeover bids at progressively higher prices. And because it was a much bigger position in GVF than Roundhill, it's really made a big difference to our returns. In April, we were up, GVF was up a bit over 2%. global share markets were down roughly 3%. So you can sort of see the swing factor that this one investment had. So very satisfying that we stuck to our conviction, and a little surprising that it's paid off as quickly as it has. But it's been a nice, if an emotional journey, it's been a nice journey through to the end.
Miles, could you just give us a sense of the dollar amounts we invested in Starwood and the music? Just
Yeah, sure.
For the silence.
So GVF's $20 million fund. So you would have had about $10 million in Starwood. Again, so the smaller liquid company. I think one of the benefits of GVF is we find these great trades, investments, but we can't put $100 million into them. I think that's one of the things that we're very determined to do, is to stay small and nimble. But we can find $10 million worth of stock and something that's, we think, very much at the wrong price. We just have to be patient. And that $10 million we would have bought over about 2 or 3 months. Very kind of meticulous, stick to your level, hang out your shingle every day.
What's that percentage?
It's about 5-6% of the fund. And then in terms of these two, it'd be similar sorts of numbers. I think Round Hill, we probably had about $5 or $6 million invested, and Hypnosis Song, it was north of 10 again. And as I said, it was a test of conviction towards the end there.
We absolutely didn't think it would be a case study for this presentation.
No, we thought it'd be 3 years from now, I would say.
In a couple of years' time, but
yeah.
It was a good one.
Yeah, but a typical investment, it's a great question actually. A typical investment, we like to take high conviction investments. We do a lot of work on the underlying, and we don't want to waste that work. So normally we'd invest about 5% of the capital in the fund in something we're excited about, and that's about 10 million Australian dollars. Hey,
Miles, there's a lot of things that fascinate me about the success of Global Value Fund, but one of them is wondering, how do you know that these things exist in the first place? Like, how do you actually know about hypnosis or sweat? And then why do you start looking at it? How do you know that perhaps here is an opportunity? Like, there must be so many millions of things. How do you find one?
That's very kind to say, Phil. Thanks. I mean, I guess...
I can give you a bit of an insight as an outsider. And Miles, you can add to this for sure. But having watched the guys now for about a decade, so they meet everybody at IPO. And I remember specifically Song at IPO, because it's a long story, but I was sitting down with an HSBC private banker who one of our clients had asked us to see, and she was going on about how exciting the Song IPO was and got to get involved. And I remember the guys, they had the meeting with the Song IPO, and the guys come round and they've got their pitch, and these guys are really good. They listen to everything, they write the notes, they start the model. The model starts on that day, the day that the IPO comes round. That's when the guys will start monitoring it in the system. And of course, I'm all excited. I'm like, oh, those IPOs, that Song IPO sounds so great. Miles is like, just give it some time. Give it some time. And so they build these portfolios and these like systems, and we have reams of them, folders and folders of companies that they have identified in our universe. And remember, the universe that we are operating in is what, $500 billion?
$500 billion, but there's probably, they're not millions of companies, there's probably thousands.
Yeah, there's probably... Exactly. So probably thousands, and then they meticulously just follow them. They build a due diligence over time, depending on whether it gets interesting or not. Sometimes it gets a little bit interesting, so they do a bit more due diligence, but then the price moves away, so they kind of step away from it. And they keep this knowledge base, which they've ultimately been building since the late 90s with James and the previous firm that Miles worked at. They build on that knowledge, they keep the information, and then it just hits. We have monitors that show us, oh, beep, 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 this has come into range, or this is interesting, or have I described that?
No. Emma's done a great job in kind of setting out the way it works. And I think the other thing to say is we run, we've got a really interesting kind of boutique strategy. It's very hands-on. We have a lot of investment managers for the relatively small amount of money that we run. There's 4 of us in the investment team managing $300 million, which is not a lot. In sort of more traditional funds management, you'd have a senior PM and a junior PM running billions of dollars. So it's a very hands-on strategy, and we spend all day, every day. We're kind of math geeks. We love it. We spend all day, every day turning over stones.
And there's a lot of frogs.
And there are a few frogs, yeah. g'day.
So what percentage of those that you investigate become fruitful?
Well, at the time, I'd say it's less than 1 in 10. You know, I mean, something like this we'd done lots of work on since IPO, but it wasn't until 3 or 4 years later that work got put into practice. So there's a lot of, what we like about doing is, the things that we invest into can be very cyclical. And I like to say everything kind of has its day in the sun and everything has its day in the doghouse. So we'll do a bunch of work on something and it's not an interesting price, but we'll save all that down. And often enough, a couple of years will go by and bonds are out of favour, or Brazilian stocks are out of favour, or music royalties are out of favour. And it becomes a very interesting kind of place to look.
Another question on Song, which is not about investment, but the decision to release to the market the change in NTA.
Yeah.
So that announcement sort of suggested the board had asked the manager to release that. Is it sort of triggers that you guys sort of go, well, mid-month we feel like there is an NTA in place, or was that like a one-off decision?
Yeah, it's a great question. So, I mean, we do an NTA once a month. We are, a relatively small team, and doing the NTA probably takes us half a day as a team. So it's a big chunk of our time that we could be doing elsewhere. So we've taken the decision, we do it once a month. We, touch wood, run a relatively stable kind of process. And if you look at our returns over time, they kind of hopefully just gradually keep going, grinding up. So we feel that once a month, nothing's really changed enough to sort of warrant updating the market. We do occasionally release those mid-month ones. We've done that, I think, 3 or 4 times.
COVID, we did that.
Did that in COVID. So when markets fell enormously and we hadn't fallen as enough, we felt there's time to actually look, guys, just so you know what's going on, the portfolio's held up a lot better than the market. That was probably the last one before this one. And then this one, because it was such a meaningful position, share markets were down a lot, yet our portfolio was up a lot. The board felt that it would be sensible to just make sure the market was fully informed.
Yeah, so more than 5% difference. Which was remarkable for us.
We don't have like a formal policy where so it's X, Y, and Z. It's more the board, pretty sensible people, and it's a one-off decision.
So how closely the board involved? Because that was like the day after the buyout, right? Like, was that you basically emailing them saying we've had a fairly significant change, or was it actually a board meeting that day? No,
well, I mean, so it's a great question. For my sins, I kind of have a foot in both camps. So I'm on the board. And I'm obviously the portfolio manager, so g'day, thanks. I'm clearly aware of these things. So as soon as I saw what was happening to the portfolio, it was just an email conversation with the directors. I said, look, this has happened. We think it makes sense. The board said, yes, that's entirely sensible. Let's do that. Yeah. Sorry.
Do you see a point in the future where you would like more capital in the fund?
Yeah, I mean, we're on record saying this is a niche kind of boutique strategy. And we're also on record saying we think the best size for GVF ultimately, if shareholders want to take us to that place, is about $300 million. We started at 50, we're about 200 now. So there's certainly capacity to grow. And I think in getting up towards that 300, we've thought a lot about that number. I think at that size we'll still be small enough and nimble enough to kind of exploit all these things we find. But it will also help with some liquidity in the stock and help drive down the costs. There's some fixed costs in the business. So we certainly would like to see it grow over time. We're in no rush. We're also incredibly sensitive to looking after shareholders and making sure that we do the right thing all the time. So we would never raise money at a discount to asset backing. We've done 5 or 6 capital raises since launch. They've always been at NTA or at a premium. At the moment, frustratingly, we're at a small discount, sort of 5 or 6%. But if we were to get back to parity, I think the board would be open to that, and certainly we've had some kind comments from shareholders that have said they would be interested in giving us some more money. So it's certainly nothing to do today, but one day if the stars aligned, then yes, I think we would.
And it's worth mentioning, obviously, I mean, you guys are probably more aware of this than anything, but the LIC industry and the structure that we're in, the listed investment company structure, it is going through a bit of a consolidation phase at the moment, and we are seeing discounts across the Australian market, whether it's AFIC or Argo or some of the really big names trading on discounts. And I think that is, my personal opinion is that has a little bit to do with maybe the rationalisation of the industry. And I think we have been affected a little bit by that. Historically, just for your information, since our IPO 10 years ago, historically we've traded at a 2.5% to 3% discount. To
Averaged
NTA.
across time.
Average across the whole time. So we've tended to trade very close to our NTA, but I think at the moment in particular, we're seeing a bit of a wider discount. Also the fact that our NTA is actually worth almost 130, which is a function of
We've had a great run of performance, and the share price
it's-
possibly hasn't kept up.
Exactly. The share price maybe hasn't kept up as much, but just to put that on your radar, that we are at a little bit of a discount at the moment.
Cheap buying.
Does that beg the question, Miles? How do you capture your discount?
Yeah, no, it's a fantastic question. I mean, look, there isn't, investing in an listed investment company, I think it's a tremendously, it's got a great place in the market as a corporate structure. You have a board, a company, it's a living, breathing entity as opposed to a trust, which is just a legal document. It can't move and change as times change. An investment company lets you smooth dividends, franking credits, there's all these great reasons for it. But one of the features of it is one of the features we like is that these things can often trade a long way away from fair value. There generally isn't like a magic solution to solve these things. You can obviously, in extremis, wind them up, but it's a pretty nuclear option to take. You want to make sure that there's no going back from that. Is that what shareholders really want? The way we've always approached it, and there's sort of the holy trinity that we absorbed from Jeff Wilson, which was performance. You have to be generating performance really to justify taking in a sticky pool of capital from shareholders. And to come back to Emma's point, there's been a lot of, I think the listed investment company structure has been a bit of a whipping boy in the Australian market for a while now. And I think part of that is there are a lot of new products came to market, and a number of them, not all of them, but a number of them didn't really live up to the promises they set out. Their performance didn't match what they said they'd do on the tin. And we're going through, as Emma said, a sort of a rationalisation phase at the moment, a consolidation phase. So performance has to be there. I think for the target audience, that a high and consistent and hopefully growing dividend stream is also very important. And then the last bit is marketing, getting out there, your shareholders own the company, getting out, seeing them, and making sure that they're engaged and excited about the experience as well. In the case of GVF, that formula has generally served us really well. We launched at $1, we've paid out over 80 cents on that dollar to shareholders over that time. We've just announced a special dividend for next year, and plus we're paying, we should be paying a very high yield next year as well. So historically that formula's worked really well. We've never had a serious discount problem. The discount's never gotten wider than 10%. It's always been single digit. And the premium's been as high as 10% in the past as well. So I think if you invest into this structure, you need to do so with your eyes wide open and understand that it will move around through time. That's one of the trade-offs that you're getting for the dividend security and perhaps a different kind of investment proposition than you would normally get. And a large part of it comes down to trust. If we had a big persistent discount we couldn't solve, we would be the first people to put our hands up and say this has to be fixed. But there generally aren't sort of quick fixes outside of winding a company up, which is, look, at the end of the day, if people don't want us to manage GVF, we'd never stay in the way in that, and shareholders can remove us these days with a simple vote. So, I don't have a perfect answer for you, but hopefully that gives you some insights.
I don't think you've ever hedged the US dollar. Is that your view going forward? And it seems to work for you. So
Yeah. It's a tough one. I think I try and, as a team, we try and stick to what we have high conviction in, which is our skill set is finding cheap assets around the world, whether they're portfolios of bonds in the US or music royalty catalogues in the UK, and unlocking the value from them. That's what we can do really well. We can't and don't add any value trying to call currency markets, and I always am a bit sceptical when I see like a stock picker get up and talk about the Swedish krona or the New Zealand dollar. It's a very different game, and most of the research shows that nobody ever calls currencies consistently and makes money out of it. Anyway, that's my kind of view. So instead of trying to call currency markets, what we do is we just have a template of currency exposures that we try and make sure we're matched to. The US dollar, as a sort of an asset class, is by far the biggest source of places to invest your money. It's the biggest capital market, so it generally makes up about half of the investable universe, and without trying to manage things, we generally end up with about half of the portfolio in US dollars. What we do outside of that is, as Emma said, just make sure the portfolio is very diversified, and whilst at times that might go against us, we've had times going for us. And over the life of the fund, it's really just been random noise. We benefited a lot at the IPO time when the Aussie dollar was really overvalued, and probably one of the few times we were comfortable taking a view. But since then, we've just kept a very kind of diversified, low-risk basket and focus on what we can do well, finding cheap assets.
The share price you've got there in the chart for SOM
Yeah.
took a very vicious uptick there.
Oh, yeah.
The biggest one that's obviously in its history.
Yeah.
You know what the underlying cause for that was? And it looks like April, and how's that gone in a few weeks since then?
Well, so that was what I was trying to illustrate. So maybe I didn't explain it well, but takeover bid. So we were buying all the way down. Concord, a group that had actually bought out Roundhill, came along and made a takeover bid at a big premium, and that kicked off this bidding war. If you can see the little dots on the way up, first dot was the first takeover bid. Then Blackstone, the private equity group that we felt were trying to take the portfolio away from us on the cheap, finally paid a decent price. Then Concord came back, and then Blackstone have just come back again. So it's been a tremendously quick kind of sequence of events, and has really helped GVF's returns over April.
And just to say, I will release the presentation, the ASX again, because we have updated it. And I have also included this graph. Simply to give investors something to compare. We, as you know, at GVF, we don't actually have a formal benchmark, but I thought I'd put out a few things that maybe you guys could compare to. GVF portfolio there in the navy, then I've got cash plus 4% in the next grey, and then I've got global markets, and then I've got global bonds. And I just thought if I showed that to you over a 10-year period, you can just see, what GVF has done and how it's performed. But I will release this presentation to the market again.
And just to explain it a little more, so we don't have a formal benchmark. About a third of our portfolio is generally invested in the share market. About a third is generally invested in global bonds, so they're probably the two biggest asset classes. And of course, our performance fee hurdle, the closest thing we have to a formal benchmark, is cash plus 4%. So as interest rates go up, our hurdle goes up with it. Hopefully, you can see some consistency through time in our returns, and then perhaps in FY22, a good example of that kind of capital preservation. We were up 3% when pretty much everything in the world was down, nearly double digits.
And that's it, folks.
That's it. So we might wrap up there. We've got some birthday cake and some merchandise. Please make sure you grab a cap.
Please, yes. Thank you.
Thanks, guys. Thank you very much.